Very good afternoon, ladies and gentlemen, clients of Brenthurst Wealth and members of the public, just common investors wanting to get some more information. Welcome to our webinar this afternoon on the 18th of May, 2022. And it comes at a very auspicious time in financial markets. Markets have been in a terrible state, and just not equity markets, virtually all markets have been in absolute shambles so far this year. And we've lined up a trio of speakers who are just not only fund managers in general, but they're also all managing a part of the investment portfolios that we give to them to manage. So it's a very good time to be speaking and asking the questions about the various strategies, because they are actually in charge of the day-to-day trading, buying, selling, asset allocation, and choice of various assets. And I'm going to start by welcoming Tavonga Chivizhe. He's from Boutique Investment Partners. And we set up this partnership many years ago, and they run our fund of funds that we offer to the investing public in South Africa, the Brenthurst Global Balanced Fund of Fund, the Brenthurst Balanced Fund of Fund, which is a local balanced fund of funds, and also the Cautious Fund of Funds. And the main attraction of fund of funds, in our view, is that it does not attract capital gains taxes when we have to make changes to investment portfolios. Whereas if you have to sell one fund to buy another fund which is held in your name, there is a capital gains tax every time you change from fund to fund to fund. And over the lifetime of an investment, this adds up to a tremendous amount of money that you have to pay back to the taxman whenever you make a profit and you decide to sell. So Tavonga will he's got about 20 minutes to discuss their positioning in markets. Tavonga, very, very analytical, and I've set him stick to 5 important charts, which indicates the various strategies in those funds. And then I'll hand you over to Tony Bell, who runs a very large fund for us, the IP Global Opportunity Fund, which, as you will find out later, we've been running this partnership with the MyPlan team, which incidentally yesterday was voted top fund management company in South Africa yet again. They've been in the top 3 for more than 5 years. Not one of your well-known brand names, but the performance has been excellent. And the performance of the IP Opportunity Fund that Tony runs has been outstanding. And he was voted the top local, worldwide, flexible asset manager in South Africa. I think this is the 3rd or the 4th or the 5th time that Tony has been given this award by Plex Crown Ratings. So you're talking to a man who's been extremely successful in selecting global funds, equity funds. Performance has been outstanding, top of more than 7 years now. So Tony has been a very, very big part of our success at Brenthurst. And then lastly, we're speaking to an old friend, Glyn Owen from London, who runs 2 of our global funds, the Brenthurst Global Balanced Fund, which is now more than 10 years old. Has an excellent track record. I think the 5-year return in Rand terms is in excess of 11%. And then we'll take questions from the public. So let's just quickly set the tone for our discussion today. If we can get our slides going. Not getting our slides going. I'm going to, my apologies, we'll get some help now. There we go. We all know that global markets have been turmoil. So the big question is, and people have been panicking, what to do now? And I think that's the reason why we're having this webinar today. People are confused, they get conflicting advice, they're panicking, they're emotional, and this is when we have to step in as financial advisors and decide and give advice as best we can. Here is a chart just to show you what has happened in the developed world so far this year. And if you recall, end of December, markets were at a record high. Investment returns have been excellent, but we started hearing the thunderclouds of the Federal Reserve indicating that it's going to start increasing interest rates. And that was followed. And as we know, January started weak. The market started selling off. that was aided and abetted, if I can put it that way, by the Chinese economy starting to turn down, the Chinese government starting to clamp down on technology companies. They've been doing that for quite some time. And of course, the last factor, which just added to the woes of investors, has been the Russian invasion of Ukraine. And that has really hurt particularly companies, countries in Europe closest to the activity, as you can see on this slide. And all these slides will be on our website, ladies and gentlemen, a little bit later today. So you'll see countries like Netherlands, and these are dollar returns. Pardon me, we have -28, Austria -28, Sweden, Ireland, New Zealand, very far away, but also impacted by slowdown in Chinese economy, and so on. The best of the developed markets so far this year has been the United Kingdom, and Glyn will talk about that because he's based in London, but it's because of the UK's large exposure to commodity listed companies and oil companies that has offered some kind of protection. Let's look at emerging markets so far this year. The best performing one, strangely enough, is Hong Kong, but that comes off a very low base. And we'll see that, my apologies, there we go. Emerging markets better start to the year than developed markets. Chile, Saudi Arabia, Brazil, Colombia, Qatar, Turkey, Arab Emirates. Two factors driving those markets: oil and gas, and then commodities, Chile, and also to a lesser extent Peru, so that there's been some kind of protection. As you can see on that slide, in dollar terms, South Africa not doing too badly, -3% in dollar terms. In rand terms, it was slightly weaker, down about 13%. So not a great start to the year, and no place to hide anywhere in the world, except maybe if you're lucky enough to have all your money in maybe Chile or one of the Arab countries, you have lost money in rand terms, in dollar terms. And of course, with the strengthening of the rand from about 16 to the 1 to the rand in December down to 14.40 earlier this month, the rand returns of your offshore investments has also taken an absolute pounding. But let's have a look at markets so far this year. Let's just go down. Let's look at the biggest market of them all, the S&P 500, by market cap, the most important index, and it shows you historically that this has now been the second worst downturn in dollar terms by the S&P 500. NASDAQ down much worse, but the S&P 500, a much broader index, it really tells you that the markets have been hurting. But, ladies and gentlemen, this is the interesting part of the slide, is that what happens thereafter? What happens after you've had a downturn of 20% or more? And the next slide will show you that your chances of making money after such a downturn, or better put, recovering some of your money, is actually excellent after a downturn. It can go down further, but history shows you that markets tend to recover after a downturn, and you'll see the recovery percentages there ranging from 16, 59, 30%, 23%, and so forth. I'm not going to spend much time on this slide. Look at the right-hand side. It shows you that since 1980, there have been 24 corrections for the S&P 500, and a correction is defined by a decline of 20% or more. But it's what happens after such a decline, and this is the situation where we are now. The decline is 18%, so it showed a bit of recovery, but the chances are excellent. 22 out of 24 downturns a year later, you've actually recovered a lot of your money. And that is where we are stepping in today and advising investors. Now is not the time to be abandoning your long-term strategy. Markets do go through downturns quite often, but it's not the time to panic and go to cash, because cash gives you no return. And as I explained to you earlier, we have a global inflation problem suddenly. After 15 years of zero inflation in the Western world, suddenly the whole world is battling with a tremendous increase in inflation caused firstly by the COVID downturn that led to all kinds of shortages, disruption of the global supply chain, and that was followed by the Russian invasion, and the price of food, oil, gas, and virtually everything else has just gone through the roof. So the world, not only South Africa, is now suffering and dealing with a very, very sharp increase in inflation. We heard today that the UK inflation rate is 8 or 9%. So if you're sitting with cash in the bank, 1% at most, you're actually losing value very fast. Second point that I need to make is that alternative asset classes, which historically have come to the rescue of people in the equity market, either bonds or gold or property, all the asset classes have been downmarked. Gold has done relatively best. And then even our new asset classes such as Bitcoin and cryptocurrencies have suffered a tremendous sell-off in markets. So there was an old radio series on Springbok Radio, the old people remember, it used to be called No Place to Hide. So there's been no place to hide from this downturn in markets, which has been quite unique. But we've been seeing signs, ladies and gentlemen, that some of the investment advice that we are getting, this is a headline from a week ago where bank credit analysts, which is one of the sources where we get our information, they have changed around, and they are very, very influential and highly respected investment house. They've basically said, time to upgrade global equities. They have become cheap. Now, there are people who might disagree with that, but we're very close to the bottom. It is for the strong-hearted perhaps time to re-enter the equity market if they have not been in the market for a long time. Just a final note from me. I often have to comment about the large and local asset managers in South Africa that try and convince South African investments to stick to their local assets. And here is the headline taken from January 2018, and it was reported in March, but the statements were made in January 2019, beg your pardon. And that's 3 years ago. The fund manager went around the country basically saying, and this was reported in the press, that the SA market, i.e. the JSE, will be the best equity market going forward, saying South African equities are very cheap, it's time to buy. So I thought I'd have a look at the investment returns from that date by Old Mutual, and particularly the Old Mutual Investors Fund, which is the biggest fund linked to the SA equity market. And lo and behold, we found that Old Mutual Investors Fund, if you compare them with the Global Macro Fund that Tony runs, even a cash fund that is also in the MyPlan stable, compared to the MSCI World Index, has been the worst performer in that category. In other words, the forecast was overly optimistic. It was perhaps misleading. And 3.5 years later, you could have made 15.5% on an S&P 500 index. You could have done the same with the World Index, the Global Macro Fund, almost 12%, and our Mutual Investors Fund, 7%. And if you compare that with the inflation rate, you barely made any money 3 years later. The point that I'm making and that I'm stressing is that South African fund managers are notoriously bullish because they have to be. The biggest part of the assets are in South Africa. But over a 10-year period, most equity funds in South Africa have not beaten inflation, have not beaten funds like the Enhanced Income Fund that has returned the same, if not more, than our equity funds, which has been historically not been the case, which does not augur well for the JSE going forward. And lo and behold, I'm ending my story again this morning on the business day. We have Alan Gray and Old Mutual again trying to convince investors not to abandon the local market and that SA is cheaper. We unfortunately don't buy that story, ladies and gentlemen. We don't work for a large asset management company. We don't have to push a certain line. Our investment decisions are based on facts and statistics and analytics. And over the 10-year period, offshore markets have outperformed the JSE by double the return that they've achieved over this period of time. And if you compound an initial investment, local versus offshore, and do the comparative numbers, a person who's invested offshore 10 years ago has almost 70% more money in his investment portfolio than you would have had with a purely local investment portfolio. That's all from me. We're going to be taking questions. You can make notes. You can ask your questions at the end. I'm going to hand you over to Tavonga. Tavonga, thank you very much for your time and your insights as usually, and also, of course, Tony and Glyn. For me, it's goodbye until later.
Thank you, Magnus, and thanks everyone for this opportunity. I'm just going to quickly share my slides and then I'll start. Just to confirm if my slides are up and clear for everyone. Great.
We're all good to go.
All right, awesome. Thank you so much. I'll quickly start off by introducing our process before I share our views. We are a multi-manager that is constantly evaluating risks from multiple dimensions, and this pyramid just gives you a sense of the main dimensions or pillars that we assess risk. The first one being just a general macroeconomic environment. The second one that we've called the macro regime really speaks to the strength of the business cycle, followed by your asset class valuations and the currency risk considerations, which really then allows us to start to construct the equity part of our portfolios, where we look at investment style allocation, as well as to make geographical allocation decisions, which is the onshore versus offshore call, which, as you'd have picked up from Magnus' comment, is also like a generally topical area subject in locally. Having made all these 6 decisions that you can see, we then move over to the implementation. And this is pretty much where manager selection comes in, because manager selection is the means through which we access and implement the first 6 decisions that you have that you can see. It's very important to us that the way we analyze risks in these different areas is homogeneous and objective, and like removes as much of the team's emotions as is possible. So for each and every one of those 6 factors, we've got a risk rating where we look at the data of a lot of these geographical of the risks that are showed relative to the history. And if you look at a variable, for example, that looks at valuation risk, like a dividend yield as an example, all else equal, higher dividend yields are better than lower dividend yields. When yields are similar to the historical trading range, our risk score would be 0. But if yields start to move higher than average, they would then start to move into the domain of 1, 2, or 3. And this would apply to any other risk factor, whether it is your GDP growth, inflation, producer price inflation, business confidence, consumer confidence, and all the risk factors that we look at within our risk environment. Those would all be rated similarly. And the combination of all of these risks then allows us to establish a risk score that then dictates or guides the active bets we take away from our benchmarks from time to time. Talking about benchmarks, our process allows us to have benchmarks for the geographical allocation, which essentially speaks to how much do we strategically allocate to South Africa, to emerging markets, excluding South Africa, and to developed markets. We would also have a benchmark for asset allocation, which is your normal asset classes. And within the equity covered, would have another benchmark for our investment styles. And we would then take bets from these 3 areas using the risk scores, typically in steps of 5%, which is something that I'll show you a little bit later. The same concept applies to currencies, where we would look at the prospective direction of the rand as well as of the dollar relative to some measure of fair value using the purchasing power parity theory. And essentially what we're trying to assess is to say, should the rand move back to its purchasing power parity fair value today, how much currency gains or loss would that translate to? If the currency gains or losses are within 0 and 10%, would classify that as a movement that is insignificant to make an asset allocation call based on. Once the potential losses start to move out of 10% into the 10 to 15 range, then the score becomes -1, because that loss means that your equities or your bonds or your property on the global side have to rally by more than the 10 to 15% for you to really make money. So if obviously the score for valuations is also negative, that then automatically means that for valuation reasons and for currency risk reasons, we are unwilling to move to a zero weight for that particular asset class. It does allow us to bring currency risks in a very clean and objective way. So having put the process and how we arrive at our views out of the way, I'm going to spend about 10 minutes just taking you through our views, and then I'll hand over to the next speaker. The areas that particularly interest us whenever we're managing our portfolios is to say, if we're starting from a blank piece of paper today, what geographical bets are we going to take? How much money are we keeping in South Africa? How much is going towards emerging markets, and how much is going towards developed markets? Once we have made that decision, we then move over to the second decision, which is number 2, to say, of the money that is within South Africa, within emerging markets and developed markets, what asset allocation are we going to implement in those different geographies? And then after that, we then realize that sometimes when everything is said and done, equities is what makes or breaks these first 2 decisions. And therein, we would want to understand the type of managers that we're going to be allocating to. Is it your quality managers? Is it your value managers? Is it your small mid-cap managers? And then that decision will be made under Pillar 3. And then we just have a way of assessing the market environment to say, based on everything that is going on, are we better exploiting these first 3 decisions using passive strategies, or is the environment really ripe and ready for very skilled active stock pickers? We will then bring all of these 4 factors into every single mandate we manage. And I'm trying to illustrate how that works today. My brief today is to just give you our views on these 4 different variables, and I'm not going to really spend too much time addressing any other factor except maybe in the question and answer segment. The graph or the charts that you can see in front of you right now is pretty much some way of looking at capital risk that our process looks at. This was really drawn on the 31st of March. And what the graph is really trying to say is to say, what is the price movement that is required in all of these different markets for the specific valuation signal to go back to its fair value since around 2005. So for the S&P 500, if you do that mathematical calculation using the historical PE, then the downside we needed to see was 20% to go back to fair value. If you do the same mathematics from a forward PE perspective and then sticking to the S&P 500, you can see that on the 31st of March, we expected a loss of 16% just to go back to fair value. And if you stay on the S&P 500 and you move to a different valuation signal, which is your price to book ratio, that downside was nearly 40%. And from a dividend yield, that downside was about 30%. So essentially, you could say based on different valuation metrics on the 31st of March, we expected this S&P 500 to sell off by between 20 and 40% just to go back into what we would classify as fair trading ranges. Fast forward to today, and you look at what has been happening in the markets. Markets have pretty much sold down, in many cases, into levels that are far more than the numbers that we had sort of put down on paper on the 31st of March. Pretty much now moving into bear market territory. So we've definitely seen quite aggressive sell-offs that are happening. And the 2 things we probably want to leave you with is that if you look at the very first part of this table and you look at where my cursor is, there are 2 lines I want to draw your attention to. The one which reads average price decline, and then the second one which just looks at the index drawdown from its previous 52-week high. And what you're starting to see is that if you look at the drawdown at overall index level, if you look at the S&P 500, for example, it's down by about 16%, but the average price in the average stock in there has lost roughly 23%. And if you sort of do this analysis across different benchmarks, what you're starting to realize is that the pain that is being felt at stock-to-stock level is significantly sharper than the pain that is being felt at the overall index level, which in our view is starting to create an environment where opportunities are arising more in favor of the active stock manager. With this particular, I think, background in mind, if we come back to how we would look at our process to make a geographical asset allocation call, the pictures or the slides I've already taken you through are just really one part of our process, which is the valuations part. And if you look at developed markets, for example, despite a lot of the sell-offs that you've seen, when we look at our valuation risks, a lot of these scores are pretty much still on the negative if you look at it from an index level. And when we look at valuations, we would look at it not only for these ideas relative to their own history, but to also just say, if we look at developed equity markets and we compare them to South Africa, what is the valuation picture looking like? And this picture is sort of almost saying they are actually trading at levels that are quite high relative to what the South African valuations look like. But to make a decision on what we think of developed markets, we would not only look at the valuation picture from that angle, we would want to get a sense of what the macro strength looks like, what the business cycle strength looks like, and the currency risk for the South African investor. And when we bring in all of these four factors in this particular fashion, what you realize is that our risk score for developed markets and the USA are quite negative at almost like -1, which all else equal would mean that we would be willing to introduce a 5% underweight to risk assets within developed markets. The conversation is, as soon as you're 5% underweight risk assets within developed markets, you automatically introduce an overweight cash allocation within developed markets. And we'll then try and assess to say, is there a region whose risk return profile today in our process is attractive enough to receive the 5% that is released from developed risk assets? Our general way of establishing risk is that if the risk scores are between -0.5 and +0.5, we prefer not to take any bet away from the benchmark. And if you look at all these geographical scores for the second quarter, most of them are largely negative. And the only three that are not negative is the Japanese score, the Chinese score, and South Africa score. But even in those cases, those scores are within our risk neutral range, meaning that as much as we might introduce a 5% underweight towards developed markets because of these negative scores, the cash that is created by that cannot be allocated to any other geographical regions because the risk picture does not really look good in that particular context. So what we end up at as a house is a scenario where we are actually neutral across the three major regions of developed markets, EM, and South Africa. But within developed markets, there is an allowance to hold cash, which we obviously could not allocate anywhere else. And for this particular cash, we're also very mindful of the fact that a lot of markets have sold down quite aggressively. And if there is any whiff of news on the macro front, we could experience a very significant and violent V-shaped recovery in the coming few months. So to a meaningful extent, we're a little bit hesitant to hold this cash, which has resulted in all of our benchmarks because of that, having a risk neutral stance across all the risk assets in these geographical areas. So this is pretty much our first view where we are neutral risk in all the regions. If the client is too conservative, we'll hold overweight cash. But for the opportunistic clients, we think that it is time to start to position for a recovery of deeply oversold ideas. Having said all of that, one of the things that is very clear to us, if you look at our developed market score, is that we record our scores every quarter. And what we're starting to see that is the trend of risk at developed region is actually deteriorating. So if you look at the Q3 score, Q4 score, Q1 score, and Q2, what is very clear is that across all geographical regions, the risk trend is moving against us. So as much as we might start to think of bottom fishing in some of these areas, we are not running away from the fact that risks are moving in a way that is not comfortable for us. And if you look at one of our research providers being Alpine Macro, we have found a way of introducing this. They sort of have introduced a variable that they call the growth tax, which is a combination of bond yields, the dollar, and commodity prices. And in this particular case, that growth tax is inverted, meaning that when the line is moving down, it means it's increasing, and vice versa. What is clear to us is that there is a leading relationship between this and ISM index. And to the extent that the growth tax has already significantly moved higher, it could drag down the ISM indices lower with it, which could cause a sharp slowdown in the US economy. So on the one hand, we are in a scenario where we are acknowledging a lot of pain that is taking place within the equity markets. On the other hand, we're also realizing that the risks could actually continue to move in a much, much worse direction than we are ready for. So we're sort of in an environment of twisted risks, if that's one way to look at it. The other thing I think we're very mindful of is that your disposable income for consumers in the US has now moved deeply negative, which generally would support this growth tax variable and create a scenario where you could have further weakening of growth, all else equal. On the other hand, when we look at macroeconomic data, one of the things we're realizing is that areas like your natural gas prices, which are a proxy for geopolitical risk or the Russia-Ukraine war, have sort of started to cool off a little bit. The COVID cases in China, which have been causing a lot of the negative news, have cooled off a bit. Some measures of supply side pressure, like your second-hand car prices and your freight indices, are cooling off a bit. So essentially what this is saying to us is that you cannot deny the fact that things can go really worse. Equally, you cannot deny the fact that there are certain areas where things are starting to look good, which could ignite like a strong recovery of asset classes that are deeply oversold. So within that, I think tension of risk, you still need to figure out how to position your portfolios in the most responsible way. And for us, the best way to respond to all of this is through a risk neutral stance. If we then move on to asset classes, having established our geographical allocation call or views, when you look at all of our scores, many of them are very close to zero. We bring in exactly the same factors from a macro and business cycle perspective, except here we start to bring in the valuation scores specific to the different asset classes, and the currency scores don't change, but you pretty much arrive at the same scenario where the only area where you may want to be underweight is your developed market equities, where the scores are out of the range where we'll take an underweight, but everywhere else, the risk scores are really not inspiring us to take any active calls, whether you're looking at your traditional asset classes or your non-traditional asset classes. So in this particular regard, we are definitely staying with a risk neutral weight. The one point we really want to leave with you though is that for the first time in a long time, our portfolios have started buying into global cash, and we've also started to buy into global bonds to a point where we've now moved that into a risk neutral weight. And one of the reasons being, if you look at this particular chart, which just gives you a sense of the return profiles of government bonds across different maturities, the gray lines give you a sense of how well and how badly bonds have done in the past. And what you can't really miss out on today is that the recent sell down, which is this dark blue line, is pretty much unprecedented. And to a point, I think it's really overdone. And when you look at other factors, like, the historical experience of developed government bonds, most of the times that they've gone through such pain, subsequent to that, they've actually gone through a healthy recovery. We link in the performance of bond yields to different types of managers. So on this particular chart, you can see that there are different managers. So managers would call quality managers, managers would call growth managers, managers we think follow the momentum investment style. And the way to read this chart is that the further to the right you go, the more these managers do well when bond yields are rising. And then the further to the left you go, the more the managers struggle when bond yields are rising. So you will see that because of the sell-off that we saw in government bond yields, managers that do badly when bond yields are selling off, like growth and quality managers, have really struggled and have incurred losses that we feel in some cases are really not justified relative to the stocks they hold. So when it then comes to constructing our equity curve out and we bring in our scores again, the general tendency is to really keep a neutral weight across the investment styles, but with some caution towards your quality and growth managers. In this particular regard, we then understand, however, that because of the sell-off in bonds that we saw and how they very negatively are related to that, some of these managers could re-rate in the short term, and therefore we are pretty much holding, again, a neutral allocation to the different styles that we hold. And then if we then bring all of the information together to say, how do we then navigate all of these decisions? Are we going to use active managers or non-active managers? In our view, we will look at this variable, which we call the stock-to-stock correlation, which really is a way of assessing if the performance that you're seeing in markets is being driven by stocks in an individual capacity or is being driven by stocks in a collective capacity. When it's being driven by stocks in an individual capacity, the stock-to-stock correlation tends to be very low. which really means that you are better off implementing your decisions through active managers. And when that number is above the flat line, you're really better off using passive managers. And in a similar way, if you do the same work at a sector level, when the blue bars are below the dark circles, it really would mean that you are better off with your active managers and vice versa. So when we bring all of this information together, I think our conclusions for the coming 3 months is that the risk backdrop is really moved against us. There's quite a lot of things that could really go wrong. Equally, we're also seeing a few worrisome risk areas that are starting to show signs that they are past the worst. And to the extent that a lot of stocks are already deeply oversold, that could help the situation, but you cannot really overdo that because there are things that could result in the current pain being extended for a lot longer. So bringing that entire message into just one slide, our views for this current quarter would be, we would then have a neutral risk stance when it comes to geographical allocation cost. So we're really not keen on moving more money offshore, neither are we keen on bringing money onshore or to emerging markets. We're just staying at benchmark weight. And then when it comes to our asset allocation stance, we are again moving to a risk neutral stance, but this time around bringing in global cash and global bonds to neutral, something we've not done in a very long time. And then when it comes to the style of different managers, we generally prefer to run our portfolios with some exposure to quality managers, growth managers, value, momentum, and your passive managers. And in this environment, we're really rebalancing to an equal weight, which allows us to top up into the quality and growth managers that are deeply oversold, whilst taking some profit from our value managers who have held up relatively better. So I think I'm going to stop here because this gives a very good, I think, summary of our thinking and how we sort of arrived at the positioning of all the mandates that we look after. Thank you so much, Magnus. I'm going to hand over to the next speaker.
Thank you, Tavonga. If you can just stop sharing. Thanks, Tavonga. Afternoon, everyone. Thank you very much for your time today. Magnus asked me just to cover a few slides on performance. I think many of you can just look this up yourselves, but I think just in the interest of full disclosure, the Global IP Opportunity and Global Macro Fund, as Magnus introduced, has done very well. I tend not to dwell too much on performance slides. I'd rather get to the meat of the presentation. That's the performance relative to the equity sector and the multi-asset flexible cumulative since inception of the IP Opportunity Fund. Very nice, consistent upward trend in performance. And that's the relative performance relative to both the flexible and the general equity sector. I think what I try to do in the management of this fund is equity-like returns with less than equity type risk. Very pleasingly, the fund has produced that type of return. This is a plot relative to a number of international managers, where you can see AllianceBernstein, you can see Net Group, you can see Lindsell Train, you can see 91 Global Franchise, Walter Scott. And the IP Opportunity Fund sits right to the left of the risk spectrum. And I think one of the key takeaways from today's presentation is really about the balance between managing opportunity and risk. I think Tavonga, even though I haven't seen his presentation before today's webinar, has given me a very nice lead in. Thank you, Tavonga. So what's this all about? We've been through a harrowing 4 or 5 months. If you go back to the discussion at the end of last year, it was all about the growth into 2022. Nothing was going to go wrong. We had the Ukrainian invasion. We had inflation out of control. We suddenly had a Fed that was behind the curve. We moved into an era where everybody in town was forecasting recession or stagflation. And on a light-hearted note, with no disrespect to any economists on the call, economists have forecast 9 out of the last 5 recessions. So it's a particularly difficult one to get a grip on. And I don't mean to make light of it, but I really do want to unpack what I think the market is seeing and why I think there's some interesting opportunities amidst all this chaos. The first slide that's important is the one in front of you. I started my investment career in around 1984. Paul Volcker came into the Fed. Inflation in the US was running up here at about 15%. He jacked interest rates to 20%. That's a proper rate hike. What we're going through at the moment, these are not proper rate hikes. That was a proper rate hike. And you can see the dotted line, which is the Fed fund rate, stayed above the black line, which is the US inflation rate for almost the entire era until we arrived at the 2008-2009 global financial crisis. And I would argue at that point, monetary policy changed. This is very important to understand. The Fed is not in an environment of the 70s and the 80s. It's not going to go back to the Volcker era. It's in the business of trying to keep stable growth in a low real interest rate environment. And that's super important to understand. So whilst the entire focus is on the short-term inflation impact, I think one's got to look through and understand that in the post-Volcker era, we are already dealing with a world that is very similar to where Japan's been for the last 20 years, negative real interest rates by design. And that's a very important consideration because in a world of negative real interest rates, you deflate your debt, but also you never push interest rates back into punitive territory as a central bank, as Paul Volcker did in 1984. And at a very simple level, you can see that on the next chart. Real interest rates are very simply the difference between what the market calls break-even inflation, where the market thinks inflation is going to be in 2, 3, or 4 years' time. And I'll show you a chart of how that evolves on the next slide, and the 10-year nominal bond yield. So where you've got a big gap like this, what the market is saying is that we expect inflation to be around 2.5 to 2.9 in 5 years' time or 10 years' time. And the nominal bond has really caught up with that and exceeded it. So here we've got negative real rates. Here we've got slightly positive real rates, 0.25%. But we're not going to go back, in my view, to the 3-4% real rates that characterized the 1984 to 2009 period. And for all the press that's around inflation at the moment, we've got to have a look and see what the market's pricing in. These are what are called the break-even inflation curves. In yellow, you've got the US. In white, you've got the United Kingdom. And this is essentially where the market's pricing US inflation 1 year from now, 5%, 2 years from now, a shade above 4%. So yes, it is high and it is sticky, but it comes down quite sharply into the 2-3% within 2 or 3 years. And so it doesn't seem as if the market is overly concerned that we're going to move into a structural runaway inflation as we had in the 1970s, which led to that very aggressive action by the Fed. And there's a really good, simple reason why this is true. The Fed at post-2008 started to introduce another tool in the toolbox. It's called money printing. Quantitative easing was the very acceptable term applied to it. And as a simple explanation, the Fed controls the price of money by raising interest rates, but it also controls the amount of money into the real economy by either printing money or withdrawing money from the economy. Bank of Japan's been doing this since 1994. There are consequences to that, separate debate outside the scope of today's presentation. But I think this myopic focus on inflation and the Fed being behind the curve is a little one-sided. The Fed has a number of tools in their toolbox. So just to try and put everything in perspective, when the Fed back in 2009 and onwards entered into the stimulus phase, the natural path of the dollar was to decline. The US economy recovered. I would argue we are now in the sort of mature part of the tapering phase. And let's just not refer to that as recessionary phase. Let's refer to that as the slower growth phase. So what happens next, and I'm watching the dollar very carefully, and you'll see how it fits in to the positioning of the portfolio and my thinking about the opportunity, is throughout 23 and maybe into 24, we get an era where growth slows. Whether we go to a recession or not, I think is a highly debatable point. And this myopic focus on stagflation, I'm not entirely a subscriber of as well. I think for certain inflation falls, I think growth slows. I think the signal we will get is that the dollar declines. And really the big debate around the equity market at the moment is how much of the slower growth has been priced in. I was watching a very good Bloomberg clip by Dr. Elarion, just before we came on to the webinar, and I think he sums it up correctly. The equity market has priced in the inflation shock, the interest rate rise, but what we're still having to assess is how much of the growth slowdown will still need to be priced in by the equity market. And that's where I'm going to share with you some thoughts and finish the talk on rather a positive note, because I think when one gets to a sort of an environment where everything is negative, as an active manager that is looking for alpha, when price dislocates from value, I start to become quite interested. We have a very high cash position in the portfolio in excess of 30%, and I'm actually in the process of deploying some of that cash back into the market. So the first takeout from today's slide pack is watch the dollar very carefully. We've seen the bond markets come off in the last week or two. It's early days, but the US 10-year Treasury has moved softer. The UK bond market, after the BOE, I thought came up with a more pragmatic assessment of where the UK economy is going. The bond yields fell quite a bit. So what we're looking for is confirmation from the dollar. And I think the dollar strength that we've seen in the last while has really been a massive liquidity risk-off trade. Folk have gotten a bit caught short with these price moves. They've needed to raise liquidity. They've sold assets down, taken price well below value in certain instances. As a simple illustration, a company like Adobe is 65% off its 52-week high. I'm not sure Adobe is worth 60 or 70% less today than it was a year ago. So from a macroeconomic perspective, the signal that I'm watching very carefully is I've seen confirmation from the bond yields going lower. I'm now starting to follow the dollar, the trade-weighted dollar and the broader dollar index to get confirmation that we're into a slightly slower growth environment. And those inflationary pressures, as Tavonga pointed out, are starting to abate. So from an equity market perspective, this 4,100 level on the S&P is important. We've held it, we're starting to bounce off it. And I think that's a very significant down move for a price adjustment as opposed to an earnings decline. Tavonga did show this. It is a very interesting chart because where I'm focusing is a lot of very high quality growth companies that form part of the NASDAQ that are now almost sort of forbidden fruit in a portfolio. I'm starting to find stocks like Adobe and Google very attractive re-entry points, having sold most of them off in the fourth quarter of last year. So the second important slide as a takeout today is to understand when equity markets fall, they fall in a stepwise approach. When interest rates start to rise as inflation kicks up and as central banks raise interest rates, the first step down in equities is because real yields move higher. And you can see here that we've now moved to about 0.25 positive real yield on the S&P. The bulk of the adjustment where the vertical axis is the price earnings multiple has been rating change. So the total return of any particular stock or index is the change in the rating times the change in the earnings plus the dividend yield. And this very marked sell-off that we've seen in equities over the first quarter of this year has really been due to a price adjustment and a rating change from factoring in higher interest rates and higher inflation. So we're at a point now where real yields are about 0.25. The equity markets fall into a P of about 18 forward. And unless we see a very significant change in earnings growth expectations, which I'm not seeing at this stage, I think that the bulk of the downdraft in equities has been experienced. And this is where I start to look for opportunities in the market where equity prices in some instances have come off between 50 and 70% in very high quality long-term growth companies. And just to provide a little bit of perspective, because we've said we've got some time, there are only 2 slides left in the deck, is in the market declines I've been through, which started off with the 87 crash, 92, 94, 98, 02, 07, 08, 2019, and now, is that from an alpha opportunity set, you find that there are 3 primary sources of generating alpha in a portfolio. The first one is you pick companies that do very well. The second one is you avoid companies that do very poorly. And the third and most productive one is if you have cash available, which we do, and you're able to buy into companies where price has dislocated from value, that is by far over time the most productive source of alpha. But it's the hardest to do, and it's the hardest to convince your clients that it's the right thing to do. On a local front, I know Magnus referred to Old Mutual, so I'll just give it as a stock example. I remember in March of 2009, we were buying Old Mutual at R4.50, where the embedded value of Old Mutual was 17 Rand. The margin of safety is exceptionally high. So I think from that perspective, I'm very comfortable that I'm starting to exploit some of the opportunities in the market. And that's what you would look to me to do in managing the active component of the IP fund. One of the factors that I look at very carefully in terms of judging sentiment is, apart from the common narrative where once things hit the news headlines, CNBC, it's probably past its sell-by date. But one of the hard indicators that we look at as fund managers is this thing called a put-call ratio. A put option is when you buy protection against the market falling, and a call option is when you buy optionality in expectation of the market rising. When the line comes above 1.2, there's a bit of panic setting in. And I'm comfortable that at this point in time, there is sufficient panic in the market for me to be thinking about what opportunities exist where price has significantly dislocated from value. And that gets me onto the second last slide, where, and we'll go through this a little slowly because I think the information content is rich. If you have a look at what companies are producing from an earnings perspective, the top left-hand chart shows you the proportion of companies which generated positive surprises versus negative. Overwhelmingly companies, and we're talking about the top 500 companies in the world, sure, they're guiding for slightly lower earnings growth. Yes, the costs are increasing, but the resounding surprises were to the upside, and the predominant level of surprise reported in sales and earnings was to the upside. And very importantly, if you had this seismic inflation shock to companies, you would expect margins to be coming off quite significantly. There are some companies that have struggled. Walmart, for example, produced a tepid set of results last night. But by and large, companies are able to maintain quite high levels of margin. For those folk that have been traveling recently, airports are full, restaurants are full. People are getting on with their lives. They're starting to normalize. And so this great prognostication of stagflation, recessionary environment, I do apologize if I sound a bit sort of off-piste, but it does sound to me to be too deterministic. These things are not easily predicted, and certainly not with the level of certainty that everyone is suggesting they come about. So from that perspective, the underlying earnings underpin to the market is still reasonably robust. And when PEs have derated to such an extent without any obvious deterioration in the earnings profile, it starts to present a nice opportunity. So my concluding remarks is that we've dealt with the top points quite clearly. I think this markdown in price also coincided with significant liquidity constraints. You've got the Fed talking about tapering. You've had a couple of hot stocks, Bitcoin, Tesla, starting to be sold off. And I think the price momentum that we saw in April after that nice bounce in May really produced something of a liquidity constraint. I look at very carefully interbank markets, things like reverse repos at the New York Fed, failed trades on the primary dealer's book at the New York Fed, and I'm not picking up undue signs of liquidity stress in this market. To give you some perspective, the New York Fed publishes every day the failed trades. A few weeks ago, they ticked up from 150 million to around about 500-600 million in the day. But at the time of the global financial crisis, they hit 2.5 trillion. And that gives you a sense, together with the reverse repo market at the Fed, which is an indication of whether banks are struggling with liquidity in the overnight interbank market. We're not seeing significant liquidity constraints. I think where the liquidity constraints came in was folk having been caught short by the downdraft in equity prices and the tremendous move up in bond yields, and had to liquidate portfolios either for client withdrawals or just to adjust risk positions. And I think that played a very significant part in how far these equity prices have fallen. So my takeout for today is watch the dollar for signs of slower growth. If we have a collapse in the dollar, it's not going to be good for growth. And I think we will see that in the bond market as well. The bonds will fall more significantly. But even as bonds fall, from an active equity manager's point of view, given the extent to which long duration equities, the high quality growth stocks, have fallen in relation to the less quality, sort of more defensive stocks, I'm seeing an abundance of opportunity in these long duration stocks to the extent that I haven't seen since 2009 and 10. So I think there's a very nice opportunity to pick up some good value in high quality companies in this market. With that, Magnus, thank you very much. I will stop sharing and hand over to Glyn for his part of the presentation.
Thanks, Tony. Just share my screen. Everybody see that?
Still coming up, Glyn, still coming up.
Have you got it? Can you see it now? Okay, it's on my screen. Let me just. You got it now?
Not yet, Glyn.
Can you see it, Magnus?
Not yet on my side.
Okay, let me just. Why is that not working then? Can you get it now?
No, Tony, did you stop sharing?
Yeah, I did stop sharing. I have stopped, Magnus, so I'm confirming I've stopped sharing.
Okay, let me just try this again. That should be on your screen now, yeah?
Not yet.
No, can't see it. Okay, let me just get some assistance from IT. Bear with me. just on now. That's not coming through apparently.
Is that on Zoom?
Yeah. Is that better, Magnus?
There we go. Well done.
Oh, nearly Steph.
Just want to make it.
Get it on full screen.
Yeah, full screen.
Great. Sorry about that, everybody. Thanks, Steph. Thanks very much. Okay. Well, interesting listening to Tony. I guess we're not a million miles apart. Can you see that still, everybody?
Yeah,
Okay.
all good.
Look, from our perspective, there's been two big shocks in the course of this year. One is the Fed's really serious hawkish shift in terms of policy, reacting to inflation that was becoming more persistent than they liked. And the second, of course, was what is happening in Ukraine. As the war broke out on February the 24th, this famous quote from Lenin came to mind: "There are decades where nothing happens, and there are weeks where decades happen." Lenin said that just as the Russian Revolution was about to start. I think the week beginning February the 24th has brought about an equally significant tectonic shift in the sort of global power balance. I suspect that Putin thought that the West wouldn't react and would turn a blind eye, just as we did when they invaded Crimea. But of course, it brought the West, and in particular NATO, together in the most extraordinary way. And plainly, Putin's war, and it is Putin's war, is being lost by Russia. But the way we see this carrying on is that it's likely to be a long and attritional battle. He's not going to withdraw for political reasons, obviously. And this is going to go on for quite some time. The West is delivering now, particularly the US and the UK, some really serious lethal weapons into Ukraine. And the UK has been doing that, incidentally, for 6-9 months and training Ukrainian soldiers. So this is going to go on, and it's almost like a proxy war. And I think the West's position on this has hardened to the extent that they're not going to deal with Russia until there's regime change. Putin and his cronies have to go. That could be a very long period of time. The reason I mention that is because this is likely to persist and remain a risk to markets. It's not off the headline screens anywhere at the moment, but it's going to remain a risk to markets. Not incidentally, because the Russian economy is going to implode, because these sanctions are going to carry on for a very long period of time. Russia is a pariah state. Nobody in the West wants to deal with them. And not because the Russian economy will collapse. It probably will. It's going down by about 10-15% this year. But Russia is not a very big economy. It's less than 2% of the world economy. It's about half the size of the UK. It's really because of Russia's dominance in raw materials. 40% of Russia's exports are raw materials. They're shown on this chart here. Russia is the #1 exporter in the world of natural gas, wheat, nickel, #2 in crude oil. And incidentally, on wheat, if you add Ukraine was typically known as the breadbasket of Europe. If you add Ukraine's production of wheat there, historically about 30% of the world's exports of wheat have come from Russia and Ukraine. Obviously not a great position to be in at the moment for the emerging world in particular, who relies on that. It's pushed wheat prices up hugely, and in fact wheat prices have gone to a new all-time high recently. So this problem is not going away anytime soon. But I just will say this: this war will end in due course. At the moment, it's impossible to judge when it will end, but it will end. There will be a gradual return to normality, but there's no turning back for the West. The damage is going to come through energy prices in particular. You will all know the numbers by now. The EU is very heavily dependent on Russian natural gas and oil. About 40% of its natural gas comes from Russia. Almost 50% of coal, about nearly 30% of its crude oil. All that is going to change. There's no turning back. So over the next few years, Europe is going to turn away from Russian imports and as rapidly as it possibly can. So there's going to be some continuing disruption to energy markets. But once we're through this transitional phase, then we're going to see things settling back down. It's some little way away, so this does remain a risk. This is a reason, incidentally, why European markets, as Magnus mentioned earlier, have been the worst hit by the invasion. So, as we all know, commodity prices on the back of this have absolutely surged. But intriguingly, you'll see those very sharp rises in natural gas and crude oil when Russia invaded on February the 24th. They have come down pretty sharply. Oil is still trading above where it was before the invasion, but it was going up sharply before then, remember. Natural gas is now down pretty much where it was before the invasion. Agricultural prices, within that, of course, wheat, importantly, I mentioned earlier, is at a new high, have not really come down so far. There are continuing concerns about that. And this, of course, is pushing inflation higher right across the world. And I think particularly damaging in the emerging world, but everywhere it's a reason why central banks are now tightening policy, of course. But the important thing is that these sort of flexible prices, which is what energy and food are, they will come down in due course. And then certainly the best antidote to rising energy prices is rising energy prices, because people cut back, and that is beginning to happen a little bit. It'll take some time, but they will fall. But you've got to look at what has happened more generally to inflation, and it has broadened out. I'm showing here a key number that the Federal Reserve in the US, the most important central bank in the world, of course, focuses on, is personal consumption expenditures. It's a broadly based price inflation index. And you can see it's gone to 40-year highs, currently a little over 6%. But if you look at that blue box, the core personal consumption expenditure, which cuts out those flexible prices, energy and food, is also running at 40-year highs, over 5%. So this is what the Fed is tackling. I agree with Tony, it's not a 1970s style situation, this isn't. And the Fed is in the process of tightening. Is it behind the curve? Yes. Is it catching up? Definitely. It's clearly given very, very strong signals that it's going to sort of front load policy. But the Fed has now reacted to this. And the big question is, how persistent will inflation be? We look at a couple of sort of indicators of that, which are pretty reliable as to whether these inflation problems become more embedded. One is what's happening to wages. And wages have gone up sharply in the US, very sharp, that dark blue line, a little over 6%, somewhat lower than current levels of inflation, but it's a very sharp rise. So that is clearly of some concern. But, and again, as I think it was either Tony or Tavonga showed this, inflation expectations shown in these green and red lines here, they've moved up, but from very low levels at the time of the pandemic here, in line with this period of, well, through this century, quite frankly. And just recently, they've been coming down a little bit. Is a really important line. That's what the Fed watches. That is inflation in the US 5 years from now for the ensuing 5 years, and it's gone up a little bit as a result of the invasion, but not a great deal. So this is not suggesting that these inflationary problems have become really embedded, and that's a view that we share. It will come down. It'll peak sometime in the course of the second half of this year, and then the base effects also begin to kick in. The year-on-year effects begin to kick in. And some of these really very high prices will begin to come down a bit. And of course, the other thing that was driving inflation higher before the Russian invasion was the supply-demand imbalance in the world, because of this great release of pent-up demand after the pandemic, meeting restricted supply chains, and that will correct. And the companies are responding to that as we speak. So bond yields have reacted very, very sharply. Tavonga showed some numbers here. These charts going up means yields rising, bond prices going down. You can see the steepness of these moves from very low levels. This is the 2-year bond yield in the States. It was yielding next to nothing for quite a long period of time here, 2 or 3 years or more, and it's gone up to 2.6, 2.7% almost overnight, and just begun to stabilize at those sorts of levels. The 10-year yield has gone up to, in round numbers, about 3%. The low in the cycle was about 0.5%. So it's a really very big move indeed. This is why we had one of the worst periods of performance for bond markets ever. And as Magnus said earlier, there was absolutely no hiding place this year, because normally when you get these really difficult conditions in markets, bonds tend to be the safe haven that people turn to That wasn't the case this time, partly because we're starting from very low yields, and partly because the Fed was signaling very clearly it was going to tighten policy dramatically. But there is some value beginning to emerge in this area. These are real yields here, which is just a little bit over zero now. Anything below that line means you're getting negative real yields, so terrible investment, but now it's beginning to be more interesting. And although yields might well go up a little more in this cycle, they could easily get to 3.5% or possibly more. They are beginning to offer some real returns on a longer term basis. So we haven't yet extended our duration in portfolios to take advantage of this move, but it's something we're watching very carefully, and that will be the next move for us. The other thing that again, Tony alluded to this, that's happening on the back of this tightening of monetary policy in the US and the prospect, incidentally, of withdrawing liquidity. The Fed is going to roll back on its huge quantitative easing program and start withdrawing liquidity from the market. So guess what? You know, the dollar goes up, and it's had a very strong year against typically safe haven currencies. The Japanese yen down more than 10% this year. Sterling's weakened off. All the major currencies have weakened off. You'll notice here that the rand has almost kept pace with the dollar, although with a lot more volatility, as you will know. But we always feel that when the rand goes through these periods of performing very strongly against the world's major currencies and actually moving in line with a really strong dollar, then that's a pretty interesting opportunity to begin to get some rand offshore. A longer term perspective, the dollar on a trade weighted basis, so this is against a basket of currencies with which it does a lot of trade, including of course the euro, sterling, renminbi, and so on, is now at a 23-year high. So it's had a big move here and a particularly sharp move here. And we're with Tony on this thing. When this thing starts to come down, which it will in due course, it may be too early to judge it. I mean, calling the top in something like this is near impossible. But at the moment, the trend tends to be in favor of the dollar because interest rates are getting more attractive in the US, less so in Europe and Japan. Japan is not raising rates at all in this cycle. They just sort of feel it may have further to go, but at some stage this will turn, and I think that will then begin to ease off these pretty tight financial conditions that we've got. A rising dollar is generally indicating restrictive financial conditions globally. And of course, the dollar is the key currency. It's the world's reserve currency. Most trade is done in dollars and so on. You've seen on earlier slides, the risk aversion index. This is a proprietary index we produce here at Momentum. It shows this sharp spike here in risk aversion in investors. This is a combination of factors, but it's building in the fact that the Fed is front-loading its tightening policy. Interest rates are going up sharply. The dollar's rising. Liquidity is being withdrawn. And normally, when you get these spikes of risk aversion, sharp spikes upwards, this was the pandemic, this was the financial crisis, it's a very good buying signal. Should we be buying today? Well, you know, if I had $100 to spend, I probably wouldn't spend it all in markets today, but I'd certainly begin to make a start on that because typically speaking, this is creating some very interesting valuation opportunities. I mean, picking the bottom in these things is well nigh impossible, of course. The other important thing to bear in mind is a lot of talk about recession, as Tony was saying. The only big bank that I know of that's actually predicting a recession next year is Deutsche Bank, but others are getting more worried about it. What is in no doubt is that there's going to be a slowdown in growth. We're beginning to see some signs of that, and it's inevitable. You know, you've got this big rise in prices, a big rise in parts of your sort of consumer basket, which you simply have to buy: energy, food, fuel, and so on. They're non-discretionary items, leaving less for your discretionary spending. It's going to come through to the high street. We're seeing it a little bit in the UK already, and I'm sure we'll see more around the world. There will definitely be a slowdown, and typically speaking, economists around the world have taken about 1 to 1.5% off global growth this year. But the world, generally speaking, and the US in particular, is entering this tougher period with households and companies in pretty good shape. So here we show the labor market in the US. Unemployment here at very, very low levels, historically very low levels. Job openings, almost double the amount of people unemployed. We've got a similar picture here in the UK, where there are more job openings today than there are people unemployed. And then you've got this pickup in in wages, below inflation today, but nevertheless, it's not a bad increase in wages. And this, there's no employment issues in the US. If you want a job, you can get one. And of course, households are going into this tougher period with strong balance sheets. Housing prices were up about 20% in the US in the last 12 months. It's the biggest single asset the US households own. It's in pretty good shape. It's going to slow down. There's no doubt about that. Mortgage rates have gone up a couple of percent in the US so far this year. So it will slow down, but we're starting from a position of strength. Importantly, corporate sector is also in good shape. Debt to earnings has come down since the financial crisis significantly in most developed countries. China is the one big exception to that, incidentally, but in the US and elsewhere in the developed world, it's come down a lot. And if you're looking for signs of stress, there aren't really many out there. Again, I think it was Tony showed some numbers on stress levels. These charts show the difference in yields between junk bonds here and treasuries. It's been going up a bit. It's not excessively high by any means. It's nothing like what we saw in the pandemic or in earlier crises. This was the Euro crisis, for instance. These are yields on high-grade bonds relative to treasuries. Got up a little bit, you'd expect that. There were very low levels, but nothing material here. So this is not indicating any liquidity crisis. There's no systemic risk out there. And banks, which went into the financial crisis in a mess, and of course the financial crisis was caused by one of the world's biggest banks going bust. The banking system was on its knees. There was no signs of any stresses in banks whatsoever. The balance sheets are strong. They're going to come through this difficult period in good shape. So we enter the difficult period actually in pretty good shape. So we're not overly alarmed about this slowdown. It's coming. It started. It will have some impact on corporate earnings, but it's being discounted. I'm not going to spend too much time on this because you've seen some of these charts already, but it's been a very torrid time indeed for most asset classes so far this year. The top here, gold, was actually one of the better performers this year, but most other asset classes were really very poor indeed. And this line here, government bonds, which when equity markets are falling and you're going into a tougher period, you'd expect bonds to be somewhere up here, just didn't happen. But they're beginning to show some signs of providing a sort of better defensive assets because of these sharp falls in bond markets and the really sharp rise in yields. The big falls in equity market, the Chinese equity market down a hell of a long way. China as a market, incidentally, since the peak 12 months or so ago, has halved. The NASDAQ index down 30%, as you saw. The FANGs index in New York, the index of big tech stocks, so the Facebooks, the Googles, the Amazons, the Microsofts, is down 40% from the peak. So there are some interesting opportunities beginning to emerge here. Is it the bottom? I don't know. Picking the bottom in these things is very difficult. All I can tell you is that they are a lot cheaper than they were, and these are very high quality companies. Would I go into sort of some of the more aggressive parts of the tech market at the moment? Probably not, because you've still got this risk of interest rates moving higher. We're at a fairly early stage in the monetary policy tightening cycle, but opportunities are coming along. This is the UK market here, which has held up pretty well. As Magnus that said, that the UK has been helped by the fact it's got a lot of oil stocks, material stocks that have actually gone up in price this year. And the UK market was cheap and probably is still relatively cheap, incidentally. I call this a sort of stealth bear market. It's actually more than that. We've got a pretty serious bear market in some parts of the markets. Value stocks here have held up pretty well. We've had the sharp sell-off more recently, but longer duration assets that both Tavonga and Tony referred to. So growth stocks that have got earnings well into the future, maybe earning nothing today, they've really been absolutely hammered, down almost 30% this year. As I say, is this the bottom? Very difficult to call. Picking bottoms in and indeed tops in markets is difficult to call. But we do know that these are quality companies now and beginning to look pretty interesting in terms of valuations. And here valuations across all the major markets have fallen pretty sharply to levels now which given what's happening to interest rates, we think are pretty interesting. Interest rates may have a little more to go up. The federal funds rate, the short-term cash rates is going to go up. The market's discounting sort of about 3% by the end of this year, but we don't see any prospect of a return to those very high levels that we were seeing in the 70s and 80s, which I lived through, and there were very, very different circumstances to that, incidentally. So valuations are definitely improving here. And like Tony, we're on the lookout here for some opportunities. We're cautious. There's plenty of reasons to be cautious still. So we're moving sort of gingerly on this. Sort of, what you don't want to do is put all your available cash into markets at the moment, because there's still plenty of nervousness around. And I've mentioned the two big risks, being the war in Ukraine and what the Fed is doing, but you've also got the situation in China, of course, with COVID. That will improve. I've absolutely no doubt about that. We all know how COVID will pan out. But there's still plenty of things to be concerned about. But this is for us an interesting buying opportunity coming along here with these valuations around. So just summarizing, I think I've gone through most of these points. So pretty big challenges that we face. Obviously the war, commodity shortages, we've got this highest inflation now for 40 years, sharp tightening of monetary policy, but it's been discounted very quickly. The markets have moved so dramatically, so quickly, that a lot of the tightening has been sort of both front-loaded by the Fed's aggressive talk, but also by how the markets have adjusted with this sharp rise in bond yields. The big question on investors' mind, can these high levels of inflation be controlled without triggering a recession or market crash? It's absolutely impossible to predict whether there will be a recession in the next couple of years. Definitely a slowdown. There's not a zero risk of a recession, but let's not get bogged down to that. We all know there's going to be a tougher period ahead. If we're talking about market crashes, we're well on the way through that. And this is not a situation where you get these sort of sudden catastrophic shifts downward. This is not a systemic crisis. And I really would emphasize that. This is not like the financial crisis, or indeed like the pandemic crisis back in March of 2020, when the markets fell 35% within a matter of a couple of weeks. Households and companies and banks are going into this period in better shape, in good shape. And these valuations of bonds, and indeed all asset classes, are beginning to look pretty interesting. It's creating valuation opportunities. So the markets have got a long way to discount on the risks, and we're beginning to think this is a pretty good time to start to add to risk. Just a quick refresher on, in just a time, I'm going to go through this very quickly. The two funds that we run on behalf of Brenthurst and Magnus and the team, an international balance fund, which is shown here, the strategic benchmark, 60% equities, 40% fixed income, and then a global equity fund, which is 100% equity. The current positioning, the global equity fund is just a little over that neutral, just over 60% equities, 30% bonds. We've been very short duration in these bonds, and that's helped us because it's short duration bonds that have held up somewhat better. And we're beginning to think now about extending that duration. We haven't yet done so, but we're beginning to think along those lines. We own some gold here, which we think will be a very sensible asset to own in this pretty challenging and uncertain environment, and a little bit of cash. And then the global equity fund is split right around the world, a little over half in the US, 17 or 18% in Europe, and so on and so forth. You can see the numbers. And then we also split it across these styles that Tavonga referred to earlier. Typical styles you're investing longer term will outperform the broader index, but with higher levels of volatility. But by blending them together like this, you tend to reduce that volatility and still get that outperformance. So diversification, absolutely key in all of this. And then the numbers, the performance of the two funds over the last few years. Obviously, we've had some pain in the course of this year, but over the last 3-4 years or so, there's certainly a very good recovery from the pandemic. And when you get these downturns, it looks to us like an interesting time to start to add to these positions. So with that, I'll stop sharing my screen and hand back to Magnus.
Glyn, thank you very much. Thank you on behalf of all of us here at Brenthurst, and to the many clients of Brenthurst who's been in your fund for 10 years. As I said earlier, if you look at the Rand returns of the Global Balance Fund, and it's one of our largest funds, well in excess of R1 billion, has been 11.5%. I mean, you couldn't ask for better. And I think this illustrates not only Glyn's presentation, but Tony and Tavonga, that we've got some very clever people looking after your money. And I'd like to thank them for doing that so diligently over the last couple of years. We have time for 1 or 2 questions, and I'm just going to take random from what I've received. One is on the view on hedge funds. I don't know what your views are on hedge funds, but we've been asked what is our view on hedge funds. We do make use of hedge funds if the client's risk profile tolerates that. Maybe Tony, you've been in the business almost as long as I've been. I mean, from the days of Cyfrits, our older clients will know the Cyfrits when you were raging bull winner in those days, and you still are. So just your view on hedge funds. Where do they fit into an overall portfolio?
I think there's a very simple answer, Magnus. The basic construct of a hedge fund is that you can exploit both the upside potential and downside in the market. The reality is that, nice in theory, very difficult to do in practice. I think what the markets have shown us post the 2008 GFC is that the Fed has a very strong hand to play in the liquidity of market cycles. And under very rising conditions, it's very difficult for hedge managers to exploit the negative side. So the hedge funds become a little bit more equity-like in focus. But I think where we're going through times like these, they certainly complement the long-only equity managers very well, because they're able to exploit the negative side of the price moves much more holistically than the long-only equity managers. So I think they're very complementary. They've got a role to play, and it's just up to the focus of the hedge manager as to where they place the bias of their bets.
Tony, thank you for that. And just to announce that we have been researching many hedge funds in South Africa. Most have not or did not pass our analysis, but we do use the Obsidian hedge fund, which is run by the Obsidian Asset Managers, also a boutique asset management company, and the returns are good during the cycle. So thank you for that. Maybe just a view from your side, Glyn?
Yeah, look, I broadly agree with Tony on that. I think hedge funds this year, particularly the momentum-driven hedge funds, the trend followers, have been doing pretty well and have provided good diversification. You've always got to be careful of liquidity, of course, in hedge funds. So some of them have got long lockups, and that always bothers us to some degree. From our perspective, the South African regulator, it makes it quite difficult to hold hedge funds in the funds that we manage on behalf of Brenthurst. Having any some form of a sort of liquidity mismatch in a fund that's daily traded is just not acceptable. So we unfortunately are sort of largely restricted, but they've certainly played a role this year in the early months of the year in this tough environment. Incidentally, I think with yields going up in bond markets, bonds will begin to play a more traditional role in due course in these sort of multi-asset balanced portfolios, something they haven't been able to do for years.
Thank you for that, Glyn. One last question. We're running out of time. We've got a minute and a half left. Peter Jenkins asked, and I suppose I aimed at myself, what are the constraints, if any, in your funds with respect to local versus offshore equities? Now, Tony's got no restriction. He can go 100% offshore if he pleases, and he can come back local if he likes to. So there's no restriction. With the Brenthurst Global Balanced Fund of Funds, there's I think, Tavonga, if you can help me out, it can go up to 100%. The balanced fund of Brenthurst can go up to 60% equities, and the cautious fund, I think the limit or the maximum is 30%. Is that right, Tavonga?
That is correct. So yeah, you are quite right. So the balanced fund, neutral position is around 45, and when we're very, very bullish, it can go all the way to 60. Cautious neutral is 20. When we're very bullish, it will go all the way to 35, just on South African equity exposure.
Gentlemen, thank you very much for your attendance today, and to our clients who will be listening, and to our newer investors looking to this webinar. We've had almost 500 people continuously listening to this, which is fantastic. Just a reminder that you can talk to any of our offices. We have 8 countrywide. We have 23 very, very highly qualified financial advisors. Most of them are certified financial planners. We've got some CAs in there, CFAs, you name it. We've got all the smart brains. And you can talk to them We do not charge a new fee or an upfront fee if you wish to hand over or change your advisory responsibilities to Brenthurst. So it's a very easy way to have someone have a look at your portfolio on an unbiased basis. We do not work for the big companies, we work for ourselves. And from me, goodbye, and a very special thanks to our marketing ladies, Glyn van Wyk and Sue Heystek, for putting this presentation together. Gentlemen, have a great afternoon. Cheerio.
Thank you. Bye.
Thank you. Bye.